Make sure you have the right CPA during an exit. I'm going to talk about questions to ask yourself to know if you need more specialized advice, among many other things. So enjoy this episode with Mike Morales. All right. Hey, Mike, thanks for coming on the show. Appreciate you being here. Could you give us just a little bit about who you are and what do you do?
Yeah, thanks. I'm Mike Morales. I'm a tax principal at Abbott, Stringham Lynch, a local accounting firm in Silicon Valley, located in Campbell, California. I've been doing this about 17 years. I specialize in closely held businesses and high net worth individuals, and looking forward to talking about stuff today.
So this conversation is specifically for people that are before or after a liquidity event. I want to call it on the precipice, but we also talk to people after they've had one, right?
Right.
So with that in mind, like how often do you get involved in business exits?
I regularly get involved with business exits. It could be small sale of assets or a full-blown, merger acquisition deal,
Mm,
depending on what the client's got going on. But, several pop up during the year. Sometimes we plan for them, several years out, and sometimes I get the client after it's all done.
yeah. Would you say it's like multiple times a month that people are coming, or is there any like seasonality that you see?
Yeah, every couple of months, but the seasonality question goes with mostly economics, right? When the economy
Mm,
is really hot, people are interested in buying businesses. There's more broker deals going on then, and more IPOs, in
mm,
relation. And then when the IPOs pull back and economy gets tight, kind of like currently right now, the people are not throwing money out to buy businesses. They're kind of looking at costs currently. So it is cyclical with the economy, but there's, in Silicon Valley, there's deals happening every month, all the time.
mhm.
So Mike, you've seen this stuff over the years. As you reflect upon it, what mistakes have you seen business owners make in their exits? And if you were to kind of wave a magic wand, what changes would you suggest to these guys to eliminate those mistakes, either pre or post exit?
Right. Typical mistakes are inadequate preparation for the tax implication of the sale or the exit. Another thing common is like overlooked important tax planning strategies. So some of the strategies happen before the sale, during, and after. So when someone comes to me after the fact that the deal's gone through, we've just missed all the pre-tax planning items. And so my recommendation is tax planning in advance is very helpful. Implement those strategies such as structuring the transaction to maximize capital gains treatment, understand your cash flow from the deal, and utilizing available tax credits, or timing, because hey, maybe I didn't put solar on, and maybe it's the year since I sold made a whole bunch of money. Now is the time to do it. So working with an advisor on timing in the year it happens is also helpful. And then the thing that people forget that I really want to point out is understanding the valuation of the business and its assets. I bring this up because a lot of clients will tell me, "Hey, I think my business is worth X million," and I go, "Okay, great." And then the valuation comes through and it's worth half. And it's very typical. People think it's worth more, but it's not worth as much because we just got out of COVID. It's not a COVID proof business, so it's cyclical with some of the cycles. So a lot of things go into the valuation, and that's why we recommend professional to do the valuation instead of you back a law envelope based on your industry. So the bottom line is the further advance you can look into exiting, the better the outcome.
What is like a time that so if you're saying the further in advance you can look, is it like a 5 years, 10 years? Is that like the window or does it depend on the business?
Generally speaking, it's 2 to 3. 5 is ideal, definitely.
Mhm.
Definitely a minimum of a 1. um, the 2 to 3 year suggestion I brought up is usually because the buyer wants to see, at least 2 years of financials and tax returns, sometimes three, and then sometimes five for the larger scale transactions.
Mhm.
So, if you only just plan, 6 months before the sale, then you're leaving all this stuff on the table. Whatever happened. Where if you're planning towards it, you can clean up the financials, in a very clean way and clean up stuff on there along the way to get to that exit.
I want to ask about bringing in outside advisors, but before I do that, you mentioned that often people, they underestimate the valuation of their business and the assets. Now, is there like a balance to that? As in, like, oh, they think their business is worth more and their assets are worth less, or one is, any like discrepancy between their expectation and reality?
Well, most of it comes to the intangible asset of the business, meaning, my client list or my widget or, my SaaS, software or whatever. So some people just think it's worth a lot more and there's more capabilities than there really are. Usually people think it's worth more than what it really is. That's the,
Mm.
you know, nine
I
times
would
out of
just, yeah,
10. Yeah.
I guess that's the ego playing, right?
Right.
You're like, this is definitely worth more. And one follow-up question,
hmm
then we'll go to the advisor's question. Um, do people, does that vary across industries? As in, would software, would there be like an inflated sense of what the valuation is versus like a service business or like HVAC repair, things like
Right.
that?
I work with a lot of service businesses, and it's across the board. Everyone thinks it's worth more.
Oh,
um, and the reason I bring up the whole valuation to begin with is because if you go get a real valuation from a valuation expert, they're going to show you the trends of how you get to there, previous years and future years, and they're going to
mm,
come up with a number, and that's going to be your value, and it's based on industry standards. It's not based on, hey, my friend's company is worth sold for XYZ, so mine's worth more than that because I have this cool future or something, right? But in reality, maybe it's worth like half of what the person thinks because that new feature is not very valuable, you know
mm,
and then the
interesting.
valuation person says, "Hey, yeah, it is valuable, but it's worth this on the market." You know,
Yeah.
based on other
So you're saying
previous
like a
sales.
new future, as in like in the future, it's that service will not be as useful. Is
Right?
that
Yeah,
like the expectation?
yeah.
Ah,
It all depends on the industry, and the valuation person that does the valuation looks at
mm,
it industry specific usually, and they have
mm.
some pretty cool analytics that they do.
Wow.
Uh,
Well, now that we're speaking about external providers like valuation experts, how common is it for people, business owners, to hang on to outside advice, advisors, CPAs, attorneys, things like that, who really aren't like up for the job of a transaction because they're buddies and they play golf together, things like that. Maybe they don't want to like ruffle feathers. How often does that happen in your experience?
Very common. Um,
Yeah.
People have these long-term relationships, and they get comfortable, right? They get comfortable with the person, they get comfortable with the processes, and yeah, it might be okay, but as an advisor, I encourage these business owners to evaluate all their advisors objectively based on their
Hmm.
experience and capabilities, because you know, there's a lot of things that go into a sale, and if these people haven't been doing, exit sales and stuff like that, they're not going to know the whole build up, to it, right? So there's a big difference between a tax preparer and a tax advisor. So I'm a tax advisor. The difference is a tax preparer gets your information, prepares your return, and sends you on your way until the next year, right? Generally speaking. The tax advisor works with you before those documents are even available at year end, then gets the documents from you, and then oversees that what we planned at year end is actually the results of the tax return. So, it's the difference of the advisor looking forward versus the tax preparer looking backwards. So a lot of times these people that they just have tax preparers and they're going through their business throughout the years, long-term relationship, right? And then they sell. Well, that advisors, they can't even advise because they're preparers, they're not advisors. So knowing the difference of when you need an advisor and when you need a preparer is crucial. And everyone that comes talk to me looking for a CPA, that's the first thing I explain to them. Do you need a tax preparer or do you need a tax advisor?
I see. So there's, because all these types of advisors or consultants or whatever, because their roles are so specialized, they're much more useful when you know when to put them in the game,
Right.
right?
And
So,
Mike, you might have some comments on this too.
well, and this has been a revelation to me over the last few years on the breadth of different types of financial advisors in my world, and I've come up with a handful of questions that people should be asking their advisors. I am guessing though that in the certified public accounting world, you can think of 2 or 3 questions that you ought to be asking that long-time accountant to figure out whether they're the right guy or gal for that next role. Give us some perspective on the kind of questions you ought to be asking.
Yeah, for the CPA, and this is coming from yourself, you say, do I fully understand the tax implications for both myself and the business, right? Because if you don't understand it, that means your current CPA hasn't explained it to you, right?
Right.
So that's like a simple question you can ask. And if they don't know and you don't know because they haven't told you, then that's probably a time to get a new advisor.
I see. Are there any other questions you can ask?
Yeah. So like for the business broker, if you're going to sell, before you go to a business broker, the question you ask yourself is, am I confident in my ability to negotiate the terms of the transaction to achieve my financial goals, right? You think it's worth this, but in reality it's not. Well, the business broker is going to tell you what reality is and what you're going to get to it, right? Going back
Mhm.
to the cyclical cycle of deals, right? The business broker is going to be like, the market's hot, now's the time to sell, or everyone's pulled back from buying businesses, maybe we should work towards selling when the economy gets back into swing, right? For the valuation expert, the question is, do I have access to expertise in business valuation? Do I know the worth of my company? Like, do I really know? The 99% of the time is no, you know,
Mhm.
because most people aren't valuation experts. And then two more I got for like the business attorney. You might have a great attorney, right? But there's like complex legal implications, with the exit that are going to require some specified knowledge. And you might need a transactional attorney just to get through the
Mhm.
exit. So, you might have a great corporate attorney, but the question is, how often does that great corporate attorney deal with exits? Is it every couple of months?
Yeah, and then ego gets into it too because I've bumped into this. Oh yeah, I know how to do all that stuff. Have you ever done it? Well, no, but I've read the books on it. Have you ever done it? No, no. Okay, so it's an experience thing. You got to have someone who does this stuff regularly.
Yeah, I found it on YouTube. That's good enough, right?
Yeah,
Learn how to change my brakes on YouTube. The car stops.
right. And you can ask, what you can ask an advisor, any advisor, when was the last time you went through this? How recent? What
Yeah.
was the outcome? What was your success from the client, story that you can share with me? You know, and then the last question I have for advisors, which people forget about, right? And Mike, you're gonna love this one. So, have I considered alternative exit strategies for potential tax and financial implications, right? So,
Right.
you might have a great financial advisor, right? Well, you just sold the business for $40 million. Does that financial advisor know what to do with 40 million versus 5 million? That's a
Yeah,
great question. So the
that's a
question
great.
is, how many of, financial advisors, sir, ma'am, do you have a lot of clients with, $40 million of net worth that you're dealing with?
Hmm.
I don't know.
And Mike, I've found that you better ask that question face to face because if you ask it over the phone, you may hear a pause and then uh, some dancing.
Right,
But it's a real question because there's a very finite number of people in my world that know how to deal with that type of net worth.
right. And it completely changes the landscape. For me, on since I deal with the high net worth individual return, after the exit, you know, the client before, got one or two 1099s, right? And now, the new brokers got six 1099s, and they all do different things. And there's like a lot of complexity. And then they buy PTPK1s, and then they're in hedge funds, and because they're hedging their wealth, so it makes sense. But does your tax preparer know how to do all those K1s reporting and tracking?
Yeah.
Yeah, I guess you don't want to be a guinea pig for an advisor,
Yeah,
right? It's just kind of like I do triathlons and I found this coach and he's like, oh yeah, I can do triathlon. I can teach you how to do triathlons. He was an Olympic triathlon coach. Olympic is the distance. It's not like the Olympic rings or whatever. And I'm like, I'm gonna do an Ironman. He's like, oh well, I've done one. I can help you out. And I'm like, I don't know if that's what I'm looking for, man. I want somebody that's coached real people. So it's kind of similar with this case, right?
hmm,
You don't want to be the guinea pig
right,
for somebody that's oh I'll take the certification. You want to make sure that they are a doctor that's delivered a baby before. You don't want to be the first one.
Several babies.
Several babies. Yeah, you know when they're a professional, they go in and they just get it done.
Right.
Um, okay, so any good like resources out there for business owners to educate themselves on the exit process? This is when they maybe want to go to YouTube. Don't know. Maybe they want to speak with a professional. Any like good resources that you can recommend to people that are pre-exit, post-exit?
Yeah. So, of course, there's a classic, books and publications, forums, conferences, networking events. The more intricate ones are like the online platforms to your specific industry or courses around educational content for exiting. So those are some things I would look at. But just generally speaking, because I know everyone's just going to go on Google right now, right?
Yeah,
So when you're on Google, you know, if you, if you're looking at a CPA firm, one of the big four, like KPMG, and they got an article on exit strategy, I could tell you, generally speaking, that's going to be, valid article and have some good input. When you go across these other random small CPA firms that just put something in Chat GTP and
yeah,
spit out an article that has no authority or no substance, those are not the ones you want to be reading.
yeah.
So you want to go to the more of the CPA firms that put out the literature. Like ASL, we have articles that come out every other month and blog posts. That's coming from like a real CPA firm versus these one-off people that are just trying to get video likes and
Hmm.
and their social status up. That's great, but some of the information may be wrong or misleading, and they could tell you one thing that could lead you down a road that you're not going to want to go.
Is there any indication of who has the most credibility? Because not every CPA firm, not every advisor is going to be like a top 10, right?
Right.
But they do still have like credibility. Is there any certification or any sort of um, signal that that is quality information that they're putting out?
Well, any reputable CPA firm, in the industry should be okay, generally speaking. But these smaller ones, and I'm talking more like the mom and pop CPA firms, it's harder for them these days versus in the past because the tax law is changing every day.
Mm,
We're all specialized here at ASL. We all have different specialties, and these smaller CPA firms don't have the bandwidth to have the specialties. They have to be generalists. And unfortunately, in this day and age in accounting, there's no more new generalists. The only generalists that are still working are people that have been doing it for 30, 40 years almost.
I see. Okay, so that means that they are they're going to be well the people at the smaller firms they're going to be really really specific in the type of any thought leadership that they would put out.
Right.
So they would they be harder to find or would the best resource I guess be going to the major firms and then after you've educated yourself then find somebody that's more local that's more niche for you.
That sounds like a good approach.
Okay, or you could find a financial advisor and they can say hey talk to this guy.
And they could send you some articles because
Yeah.
like me looking for exit article that has authority and substance, I probably could find in 3 to 5 seconds. A,
Hmm.
a regular person that doesn't know tax law and everything could spend 3 to 5 minutes looking, and they may not even looking for the right thing, right?
Yeah.
So
Yeah.
again, working with the right professionals is key. And then another thing I want to point out, and Mike, feel free to chime in on this one, is working with professionals that work together because you can have a great CPA, great attorney, great financial advisor, but if none of them talk together, and you can't build a team, your
Mm,
success is going to go down. So I always tell people, you want advisors that can work with other advisors. You want advisors that are easygoing and flexible and that are going to listen and not just be closed-minded.
mhm.
Because
Dude,
when I get into some of these deals, things can go one way or the other. The allocation of the purchase price is huge. So working with the business broker to make sure they get the right allocation on the fixed assets and then moving things to like capital gain treatment is crucial. And paying that advisor to do that, the tax savings are way bigger.
so question about after the exit, right? Are there any issues that traditionally come up that you see all the time that you want to like warn people against, or what are the types of issues that come up?
Right. Yeah. So some of the issues that come up when the deal is about to close and everyone thinks they're got their money and everything's ready to go is, SALT income tax issues, meaning sales tax, state taxes, city taxes. So the problem is a lot of our customers are on the web and they're across the United States, and they may go into other states and not file there. Well, what happens during the sale process is the buyer does their due diligence and they check to see, should this entity be filing in those states? Should this entity be paying sales tax it hasn't been paying? And the problem is when this stuff comes up in the 12th hour, when you're not getting in front of it again, um, your price is getting reduced. And so what you want to do is you want to be on top of that before they figure it out. So are you caught up on all your financials? As they say, is there any skeletons in the closet? What's the status of your employee retention credit? Have you gotten it? Are you for sure getting it? Is it going to be a liability you have to pay back? Because you're banking things on government shutdowns. And then the other thing is for S corporations, it's one class of stock and they need to be pro rata distributions. If the distributions go non pro rata, you just blow in your S corp, and now you're a C corp.
Oh,
Gotcha.
you can go from being a C corp to an S corp,
And you can go from S corp to C corp.
not by your own accord.
Yeah.
It's like a forced transition.
Well, yeah, you don't purposely do it, but yeah,
Yeah.
it can happen.
Wow, that's so strange. Well, that's also. Did we ask about the like steps involved to make sure you have the right CPA after an exit? I don't know. Did we cover that yet?
I don't think
I
so.
think,
A little
well,
bit.
You did.
I think in the context that my experience is that the business seller is so fully focused on getting the deal done that they forget to think about themselves.
Hmm.
And so it's only, I bump into this all the time. It's only well after the deal's done do they start, because then they got to help make sure that the two companies mold together and things like that. So it ends up being that they need to do the shopping, but they run out of time prior. And that's when they revert back to their old advisor. And as you pointed out, Mike, if you go from being worth 2 million to 20 million, you got a different set of problems, and you got to find someone who can address those problems. And it's usually not the same person. So, Ryan, I think we did cover it in the context that you got to go out looking, and Mike, you just brought up a really key point. You got to have a situation where advisors will play in the same sandbox together. I have in
Yep.
countless encounters reached out to a client's accountant and they don't want to talk to me because it represents more work and they're afraid to bill the client for that extra work. So you got to find people who will play nice in the sandbox together.
Yeah. Can I add one thing to that?
Yeah.
Again, back to the CPA, right? And working with advisors like Mike is talking about. So the thing with people need to ask for CPAs is, what's a CPA's availability?
Yeah.
What is a CPA's industry, experience? And then the last thing is, what's the approach to client service? Like, what's the deliverable? Like, you're going to go do a return for me. How are you going to give it to me? You're going to do a projection for me? Well, how are you going to relay my estimates and how I'm doing? Like, is there a process? Is it streamlined? Because, I streamline it with my clients to make it easy because, again, like Mike said, these people are busy. They want a 30-second blip of what they owe, when they owe it, and what's going on with their business and where they're heading for the year.
How can people find out more about you, Mike?
I'm on I'm on LinkedIn. I'm on ASL's website at aslcpa.com. I'm in networking groups. I'm in local chapters.
Yeah. And you're based in which city?
San Jose.
And where do you service?
So West Coast. So California, Washington, Oregon, and some in Nevada and Arizona and stuff like that. But mainly West Coast is my specialty.
Thanks, Mike.
All right.
Appreciate you coming on.
Thank you.